Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. In 2024, inflation began to cool and central banks embarked on long-anticipated rate cuts, sparking a rally in stock markets. As we move into 2025, the big question is, can this momentum be sustained? How should investors navigate global trade tensions, continuing geopolitical tremors, and the threats and opportunities of a second Trump presidency? Is inflation on its way back? Well, today I'm delighted to be joined by three managers to discuss the year that was 2024 and the opportunities and challenges going into 2025. So a very warm welcome to Jean Roche, Lead Fund Manager at Schroder UK Midcap Fund, Paul Niven, Fund Manager of the F&C Investment Trust and Head of Multi-Asset Solutions at Columbia Threadneedle Investments, and Carlos Hardenberg, Portfolio Manager of Mobius Investment Trust. Right, on to the questions. Could you reflect on your performance in 2024, particularly what went well, what went badly, and why? And I'm going to kick off with Paul.
Thanks, Annabelle. Well, 2024 looks like it's going to be a very good year in terms of our returns. Our NAV return at the end of November was over 20%, so very, very strong in absolute terms. It's also been a reasonable year in relative performance terms. We're ahead of market benchmark, helped by strong performance from listed equities, especially the US, and we're ahead of most of our peer group as well. So overall, I think it's a very pleasing year in performance terms in both absolute and relative terms. Perhaps not surprisingly, the strongest performance that we've enjoyed is from US growth stocks. We've had very good absolute and relative returns despite an underweight position to the Magnificent Seven. We also had some really good stock returns from holdings in some of our US value names like Vertiv, which is up 165% or thereabouts year to date. They provide cooling for data centers and have benefited from the AI boom. And that follows an exceptional 2023 where they actually delivered returns which exceeded NVIDIA last year. Also, Vistra Energy, that's up 320%. So it's got some really positive individual stock contributions. What went less well? Well, as I said, we were underweight the Magnificent Seven, so there's a bit of an opportunity cost there in performance terms. And our allocation to private equity cost us some relative return. Performance has been broadly flat so far year to date. So we may get some progress before the end of the year, but against very, very strong listed equities, that allocation has been a drag.
Thank you so much, Paul. Good to hear. Generally, it's been a good year. Jean, would you like to reflect on your performance? What went well? What didn't go quite so well, and why?
Thanks, Annabelle. Yeah, so also a decent absolute performance of 17% return on NAV, and that's to the trust year end of September 2024. I'm very happy to report a record dividend as well, even though we don't run a dividend, an income strategy, 21.5p dividend. So that grew 5% in the previous year. So beating inflation and making the dividend an 11 bagger over the 21 years that we've run the trust. So we like to look for multi-baggers in this team. So it's great that we can say that about the dividend as well. What went as planned? Well, I would say, it felt like a surprising year, but actually interest rates started coming down, and that was the plan, and that's very good for UK mid-cap shares, particularly interest rate sensitive. Although we're seeing the sort of the Russell 2000 reaction to those is being somewhat more extreme, so maybe there's some following to be done there by UK mid-caps. And we also saw that the Labour government got in, which was as widely expected. And then when you contrast that with the US, where I would say it was, everybody expected that it would be it would be quite tight. And actually the majority that was achieved there was probably not as expected again. And had a lot to do with the economy from what I hear, and how one party campaigned. The Republicans campaigned more on the economy, and the Democrats weren't anticipating that. So Compare that with in the UK where things have been more as expected, possibly not in the micro in terms of then when you start looking at the budget and the actual policies that are being put forward. But I think you can say that, the UK companies are rather strong and able to adapt, particularly the best quality mid caps to those. The financial stocks that we invest in terms of what's gone well, the financial stocks, some of those have done rather well. Companies like Just Group, which met its financial goals 2 years ahead of time. So refreshingly, in contrast to the government, which sometimes isn't able to meet some of its goals, hitting those targets. That's a bulk annuity purchaser. So that's probably not in people's everyday chat at breakfast, but that's companies been growing like a weed. So that's Just Group. And then the other one is Paragon, which is a buy-to-let lender, has also had a really strong year. Where things haven't gone as well, probably some of the more cyclical companies maybe more exposed to slowdown in China, and maybe ones where we hadn't really anticipated the level of destocking that has occurred in some markets like medical. So two stocks that have been a bit disappointing, but which one, for example, Victrex actually, which has reported reassuring results today and is up about 15% as I speak. So, after the pain, sometimes there comes a bit of a relief, but that's a sort of cyclical aspect that's maybe beginning to turn now. So yeah, I'll stop there and let the third manager, Carlos, answer your question.
Thanks very much, Jean. Good to see those financials performing well, and good to see some good news after the pain with some of the cyclical stocks. Carlos, what went well for you and what didn't go so well, and why?
Thank you, Annabelle. Yeah, it was really a mixed year in emerging markets with plenty of positive developments, but also a lot of problematic phases. There have been elections in many of the larger markets like India and other markets across Asia. And then geopolitics didn't really help out too much. The recent strength of the US dollar and the threats coming from the US, especially about universal tariffs, are also causing uncertainty. Nonetheless, long-term performance since we launched the strategy has been outstanding. This year, the markets were largely moving sideways. We are up just a touch below 10%. We've so far outperformed our benchmarks. What really went well, and that's noteworthy, is Taiwan, followed by India, South Korea, and to the surprise of some, Turkey also performed pretty well. In Taiwan, particularly the exporters and the technology-oriented businesses. In India, we invested in a company called 361, which is a wealth management business, quite similar to a Julius Baer in Switzerland. And of course, with the increase in household income and wealth creation in India, they have a huge addressable market and are performing in accordance with that very, very well. In South Korea, we invested in exporters, especially in the medical and healthcare segments, and have invested in one of the world's leading exporters of medical healthcare devices for skin treatment, and they're market leaders in different geographies, including Latin America, but they've really benefited from a recovery in consumption. In Turkey, we invested in an airline software business, and as the airline industry has recovered, of course, volumes came in quite well, and that also translated into strong earnings growth for this particular business. What was more disappointing this year, but actually makes us quite excited more about next year and 2026, is Brazil. Brazil, a very fragile economy run by Lula now, with certain slippages on the fiscal framework, but also inflation, which is quite stubborn, and interest rates, which remain quite elevated. So the consumer is still somewhat negatively impacted by this environment. And then, of course, Hong Kong, which is increasingly under pressure, where the recovery of especially Chinese visitors hasn't been as positive as expected. Those are really the main markets. Another smaller market we're quite excited about, which also begins to deliver, is Vietnam.
Thank you so much, Carlos. So a real mix of countries there doing well and some not quite so well. So looking forward to 2025 and beyond, I'd like you to ask you what's your greatest cause for concern? And this time I'd like to kick off with Jean.
Thank you, Annabelle. Yeah, the list could have been quite a long one, actually. And we get the Global Fund Manager report from Bank of America every month, and it shows us, what's moving up and down in terms of cause for concern. So if I had to pick one, sort of more generally, it probably would be sort of geopolitical tensions and how they are managed. And that's why I have a fairly high weighting to defence in the portfolio. Also, I note just hearing John Healey on the radio this morning talking about the UK's commitment, the Labour government's commitment to 2.5% of GDP into defence. And I think it feels like that's happening in more of a hurry than before. So, as fund managers will always do, turn a cause for concern into a reason why the fund is well positioned. But I do think that with UK mid-cap valuations where they are, we're in a fairly well underpinned place. But if I had to say, where I would be concerned and where I'm looking at my portfolio again is, can companies continue to drive prices up? And we're already seeing some companies falter there. So if they can't, do their margins start being eaten into? Are we going to see that the margin that we thought was 15% is actually 10%? And, are we going to see that companies, just actually don't have the pricing power that we thought they had? So that's why we want to buy shares in unique companies where the supply of what they do can't meet the demand, and therefore they have pricing power. But I think it's where you start losing that pricing power, or you discover that there's none there, where actually then the valuation underpin falls away. So that would be the biggest cause for concern in the portfolio.
Thank you. So pricing power, but you did also mention geopolitical concerns. So we kind of gave you two there. Okay. Moving on, Carlos, what's your greatest cause for concern for next year and beyond?
I think the areas we need to keep a close eye on certainly are the situation in the Middle East and the potential for further destabilization, but also the situation obviously in Russia, on the Ukraine, to be more precise, and further destabilization, which could easily happen, would cause further negative sentiment towards our asset class, would impair trade, would weigh on global sentiment. I would also probably call out the potential of a scenario which may be dominated by political chaos coming from a disorganized administration in the US with constant policy changes, which will make it very difficult for companies to plan. So those are certainly things we watch, but also obviously also on top of our minds, although we have close to nothing in China directly, the situation in China around the real estate market, the situation around very, very high unemployment, a weak labor market, also weighs on consumption across Asia and investments. So those are other areas. But overall, the ultimate question is it priced in or not? And looking at the discount that EM is trading against the US market, which is close to a multi-decade high, trading at a close to 70% discount, depending on what you look at, earnings or book values, indicates to me that there is also already quite a lot of this baked into the situation. Of course, the strengthening dollar is a mixed signal. A strong US economy is good, but an overshooting US dollar is bad news for certain companies. So those are things you have to navigate. Those are things you have to put into the equation when you make investment decisions in the EM context.
Yeah, it's good to see that a lot of these quite concerning risks are actually priced in. That's some reassurance to investors. Paul, what's your greatest cause for concern in 2025 and beyond?
Yeah, I think as Jean said, there's always a lot of things to worry about. And when you look forward into the next calendar year, there is a long list of things that could go wrong. And I think in contrast to what Carlos has said with respect to EM valuations in global equities in aggregate and the US specifically are high. Markets are concentrated. The US has never been a larger weight in global equities that US market is dominated by a small number of names. Profit margins are at elevated levels. So there's a lot of good news in the price, which suggests that there is limited scope for disappointment. Now, I personally don't think that valuation levels are sufficiently extended to suggest that markets in the US and the Magnificent Seven, for example, will collapse under their own weight. So I think you need a catalyst. I think most likely that would either be interest rates, discount rate on future cash flows, or on earnings disappointment, and possibly both. Most likely area that could cause such disappointment, either in terms of rates or earnings, may well be related to US policy. Tariffs very much a focus of discussion. We don't quite know where we're going to land in terms of what tariffs will be imposed, but there will be tariffs, and it's likely to hit some of the emerging market economies hardest, specifically China. That will push up inflation in the US. Modestly, it's likely the central bank will look through that. If they don't, then that creates a bit of a challenge in terms of current rate expectations. And there may be a retaliatory action depending upon the scale of tariffs that are pursued by President Trump when he comes in. So that would be, and the uncertainty aspect will be detrimental for global growth overall. So I view that as a risk factor rather than a central case, but one can paint scenarios clearly where US policy does lead to an adverse outcome for markets. And just one additional point, it might well be actually that central banks have eased prematurely, and growth is actually a bit more robust in the US than expected. Maybe the labour market is somewhat tighter. Maybe wage growth doesn't come down as expected. And if that is the case, again, and central banks were to turn course, that would have an adverse impact in terms of interest rates and potentially market valuation. So a long list of potential things that can go wrong. But US policy is reasonably high up the list, and tariffs specifically.
Well, that I can understand, because one's never quite sure what Trump is going to do next, and what he says he doesn't necessarily do. But I think that's you've really made that very clear. That's a concern. But obviously, the past has actually bode well for the US, so we'll see. Going on, Carlos, looking to 2025 and beyond, what's your greatest cause of optimism?
Well, with an emphasis on beyond. Nonetheless, I also see light in the next 12 months. But what's really driving our interest, and what's driving my humble excitement about investing in emerging markets, is the buildup of intellectual property and the buildup of know-how and skill in these countries and in the private sector, providing increasingly unique business models which are catering to some of the most exciting transformation processes within key industries, whether it is alternative energy, whether it's within the automotive industry, whether it's within technology and communication industry, whether it's the configuration and nature of data centers and high performance computing. If you really drill down into those industries and seek and search for the winners and the businesses which are at the forefront of innovation, you do find them in emerging markets. And that is, to me, the single biggest opportunity of the asset class, aside from the well-known and well-understood trends that relate to demographics and household income increases and sort of new consumption patterns in those markets, of course, on the back of the fact that 85% of the world's population reside in those countries. But that, to me, is second. What comes first is really those innovative businesses which we find in the end.
Really innovative, entrepreneurial, exciting businesses in exciting companies. I can really, really understand why you're so excited about that. Paul, what's your greatest cause of optimism?
Well, I don't think we should forget that the fundamental backdrop, notwithstanding the numerous risks, the fundamental backdrop is good. Growth is relatively robust, led by the US. inflation is moderating, rates are coming down. That tends historically to present a relatively constructive backdrop for equity markets. Now, equity markets ran pretty hard into the easing cycle, which is now underway. So maybe some of those gains have been front end loaded, but nonetheless, it's a relatively supportive fundamental backdrop. But beyond that, I would say, as has been the case historically, the application of technology to improve productivity gives rise for optimism, whether that's through AI or other means. Often people overestimate the speed of adoption, but underestimate ultimately the extent and the impact of new technologies and what that might mean. AI is somewhat different from other technological applications in the sense it's capital light. Infrastructure to run AI applications is already in place. So a lot of the work has been done in terms of the investment required for the rollout. There is clearly a lot of investment that's been undertaken by companies right now, but a lot of that infrastructure is already in place. The adoption rates are very high compared at this stage of the cycle compared to where we are in comparative technologies. And it is possible, or indeed probable, that this technology will push up productivity in coming years. That there'll be a lag. It'll take time for it to be evident. If that is the case, if productivity improves, you're going to have lower labor costs, maybe increased profitability, increased demand, lower inflation, and that's good for owners of capital. And ultimately, in aggregate, there'll be winners and losers, Clay, but ultimately investors in equity typically. And I don't think we should forget, again, when one makes analogies to the late 90s, early 2000s, and look at what happened to stock markets and the boom and subsequent bust, there was a very real impact actually in terms of productivity enhancement after that TMT boom. So in coming years, looking beyond 2025, technological improvement, AI and other aspects may well lead to an improvement in productivity growth, and that should be good for profits and good for equities.
Thank you, Paul. To me, technology is totally transforming my life at the moment, and it's also transforming how we work. And here we are on screen right now. Jean, what's your greatest cause for optimism in 2025 and beyond?
Well, yeah, I mean, I'd have to agree with that point on AI and it being useful, because I think we all had the sort of poems that we were writing 2 years ago, plugging in a few words about one of our children on ChatGPT and getting it to write a poem, but it's actually making it useful now. So learning more about prompt engineering to make the day job of being a fund manager easier, of, wading through those ever increasing annual reports, and just getting better at using that makes me feel quite optimistic. Actually, I see that coming through this year, and in the day job, that it can have a practical application and then help to solve some of the productivity puzzle that we see here in the UK. But I think outside of that as well, I think I'm optimistic because I see in the UK relative stability. Okay, relative when I talk, you look at France, for example, so political stability, some of the rules becoming clearer. I see hiring plans, which are quite positive for UK corporates. The Lloyd's Business Barometer talked about corporates seeing their own future as being more positive than the general economy. So I thought that was interesting because, that they're seeing obviously opportunity for themselves, these UK businesses. And then that's layered with in the universe I invest in, UK mid caps, the forecast 20% earnings per share growth. Look, I'd take 15%, over the next year, but I think that that gives me cause for optimism. But we need to look well past 2025 as well, as Annabelle posed that question. And so I think skilling up in AI, generally for us, the corporates, I think that's the next thing that gives me cause for optimism.
Well, thank you, Jean. Yes, a lot of technology and an AI improving productivity, hopefully very exciting and very helpful for equity investors. Now, I want to ask you an individual question. Paul, following Trump's re-election, what is your outlook and how do you think tariffs could impact your portfolio?
Yeah, so as I said, I think the fundamentals of the global economy are arguably getting better. Inflation and rate shocks from past central bank hikes are diminishing. We're seeing real incomes growing at a reasonable rate. Credit growth is improving. Housing markets are improving. Labour markets are easing in a relatively orderly way. So it's a reasonably constructive backdrop in terms of that fundamental picture. Numerous risks, as we said. US, I think, does look well positioned. Growth there probably will slow modestly. That should not be problematic. Rates will continue to decline, and the decline in rates will help to cushion the impact of high valuations. I think the premium earnings growth rate of technology in general and the Magnificent Seven cohort in particular against the rest of the market will diminish over the next year, but will remain positive. So the notion of some broadening in markets makes sense to me, but I'm not bearish on big tech. I think portfolios do need balance between that growth aspect and those large leading companies and cheaper areas, whether that's in the US or indeed elsewhere globally. So I think it's important to retain a diversified approach geographically and by sector. And the tariffs specifically, again, we don't know where we're going to land here, but 60% tariffs, which have been flagged by Trump on Chinese imports, would very severely disrupt supply chains. I think they'd amplify risk aversion globally. China does account for around about 14% of US imports, and that's down reasonably materially over the last 4 or 5 years from more than 20%. So tariffs are probably going to be focused on strategic, or high tariffs are going to be focused on strategic areas like defense, technology, those areas taking priority. And if we were to see Chinese tariffs in aggregate, or tariffs on Chinese goods, I should say, average something closer to 20% than 60%, that's going to hit Chinese GDP maybe by 0.7%. I expect that the Chinese authorities would respond through a stimulus package, maybe weaken the currency, and that would offset to a great extent the direct impact of those tariffs. And it remains to be seen clearly what retaliatory action could be taken by China and other markets in the event that tariffs are imposed. So tech dominance, I think, probably persists. Deregulation could expose some of those large players to greater competition and scrutiny is another aspect of potential policy change. And I do think that the environment that we are likely to face in 2025, notwithstanding the premium valuation on US assets, favours the US market over other areas for the foreseeable future.
Thanks, Paul. You've made a very strong case for the US there, definitely. Carlos, what themes or countries are you particularly positive about next year?
So within the emerging market opportunity set, I would have to answer this question very clearly with Asia being the region which fills me and us as a team with the greatest excitement. And it does help to spend time in Asia in order to understand the opportunity sort of through the local perspective. And it's also good to spend some more time there to also disconnect from some of the sometimes very biased news flow and sentiment we are exposed to in on this side of the planet. In Asia, everything is, you talked about some of the tech names in the US. In Asia, the name of the game is AI, no matter whom you talk to. NVIDIA is obviously all over the place. The good news is we have a couple of NVIDIAs in Asia, not just one. And when we talk about, for example, factory automation, when we talk about innovation within communication, when we talk about new energy, when we talk about the transformation of mobility, the ideas, the components, the technologies being developed in Asia largely. And the companies are well positioned to benefit from a multi-year transition of these industries. And I'm talking about component suppliers. I'm talking about specialty businesses which focus on high performance materials, for example, copper clad laminate substrates, all of these special materials, cooling technology for data centers. There's going to be a completely new, very innovative and sort of revolutionary configuration of how large data centers are laid out and how they're run. And it's not just about the power, it's also about managing the energy and the data flow within the data centers. And again, the businesses which provide those ideas and components and technologies and solutions sit in Asia. Aside from this, I'm also quite excited about healthcare. Certainly, there's a big gap here, and as household income is rising and as demand is changing, healthcare is increasingly being localized and healthcare is being democratized. So access to proper healthcare across Asia is an increasing theme. It's a large theme, and it's a multi-year theme which we can benefit from.
Thank you so much, Carlos. Sounds like there's going to be a lot of innovation in technology in Asia, and healthcare. It's interesting you mentioned that because it is the sector that's been tipped by our fund managers as the best performer for next year, actually. Jean, we're starting to see some rate cuts from the Bank of England. Where are you seeing opportunities for UK mid-cap companies now?
Well, it's probably worth looking at, the effect that this might have on the consumer. So we know that we have several hundred billion sitting in cash deposits in the bank in the UK. So for that consumer, it could perhaps encourage them to start looking at spending, or maybe, even investing in equities, and potentially in UK equities, or, I think probably, as all three of us fund managers would probably say, any equities would probably be good. But, sort of encouraging that, quite that very stable pile of money, which actually keeps growing. I believe it was 8 billion per month into cash ISAs at one point in the last sort of 3 or 4 months. So, and that it doesn't strike me as, being capital at work, really. So it's not being spent, and, it's not actually being used to generate, it's not productive either. And then on the other end, maybe the people who don't have savings who will benefit from the rise in the living wage coming up in April. So, that end of the consumer spectrum as well. And so I think I'm seeing, selectively some opportunities in some of these UK consumer companies which have a supply, I think, as I mentioned earlier, a supply of something that's quite restricted and high demand. And getting some stimulus in terms of the higher end consumer and the less well-off consumer, both being able to participate more in that and freeing up some spend in the economy. So that's where I see the opportunity. And, you mentioned the US was the most popular, but fund managers were tipping UK a second. So I'll wave that flag there as well.
Fingers crossed with both the US and the UK and emerging markets. There you are. I'm being completely level-handed here. I'd like to thank our managers very much for joining us today. It's been great to hear their views. I'd like to emphasize that we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you're in any doubt, you should talk to a financial advisor. Thanks so much for watching today.